ladies and gentlemen, we have some big news to go over here in this video. Remember just the other day, Trump called on what we thought was the Fed to lower rates? Well, that's apparently not what he was implying. This is huge news. I'll explain it for you here in this video. And it could help to understand why 10-year Treasury yields fell so much today. If this is the start of something new where interest rates do fall, not because the Fed has cut rates 100 basis points or 1%, and 10-year Treasury yields have went up 1%, really just restricting the economy even more. It's like the markets don't care if the Fed is raising or lowering rates on the long end of the curve. Auto loans, car loans, business loans, none of that has eased up any pressure at all. Equities, for that matter, you don't value equities on what the 1-year Treasury yield is doing or 2-year Treasury yield is doing. No, everything is kind of pegged to that 10-year Treasury yield. And let me tell you, this is bombshell news because it gives us a little bit more of a guideline to go off of. I think it's giving us some insight to maybe what's happening with DOGE. I think DOGE is a big part of this, and we'll explain that throughout this video. Now, of course, Tesla was down over 4% today. If you include the fall today and after hours, you're actually now at a pretty critical level, make it or break it kind of moment, if you will, for Tesla's stock. And we will talk about that as well in this video. If things do not get better in the following days, from a technical perspective, and we know Tesla follows the technicals very closely, we could pretty shortly be a $330-ish stock, which would be downside of about $45 from here. I mean, you're already down $115 or so from your all-time high, so you've already felt a lot of pain. And if we do end up falling to the 330s, well, it's just going to be more painful. That would be a almost 33% fall from the high to the low. And I think that will present a massive opportunity, even more so than the current, 20 plus decline from all-time high is presenting. And you're currently down about 22.5% from those all-time highs. Start with this huge news. Okay. U.S. Treasury's Besant says Trump wants lower interest rates, focused on 10-year Treasury. Besant is a Wall Street guy. He knows what the Fed has been doing, that it has not helped 10-year Treasury yields. It has not helped the actual interest rates that matter for the economy or that matter for the stock market to actually come down. The Fed has cut rates 1%, and it's made things worse. 10-year Treasury yields went from about 3.5% up to about 4.7%, 4.8%. You're now down a lot today, and it could be because of this, and I'll elaborate in just a moment. Besant said, again, that Trump wants lower interest rates. Besant says he and Trump focused on 10-year Treasury yields. Now, to understand this, and where a lot of people may not get this, is you kind of have to be a little bit of a bond expert, okay? And I don't try to, pat myself on the back here, but I've spent a lot of time studying bonds, different durations of bonds, what affects the bond market. Because the bottom line is, the bond market is 2 to 5 times larger than the stock market, depending on what's going on. Obviously, if you're in a crash and rates are falling, and that just means investors are going out, they're buying the bonds, they're selling stocks. So COVID lows, like the bond market was like 5 times larger than the stock market. Right now, it's probably like 2.5 times larger, but it is massive, okay? So when bonds are doing something, they're usually right. Equities have a lot of euphoria and a lot of fear that can get injected into them on a day-by-day or even minute-by-minute basis on headlines. That happens a little bit in bonds as well, like don't get me wrong. But when the bonds start doing something, when they start telling you something, you want to listen. And that's really my backstory, why I focused on bonds so much in my career, okay? Because it helps you understand what's going on in markets a bit. So back to the question. What is driving 10-year Treasury yields higher? Well, there's a couple different factors. To a lesser degree, it's inflation expectations. On the other side, it is this deficit spending, this massive budget that America has created. Now, the principle of return is risk, okay? The more risk you take, in principle, the more return you should get. So what bond markets have been discounting lately is higher risk over the next 10 years, over the next 20 or 30 years, that the American government's financial situation is just going to get worse. So imagine it like this. If, again, there's actually a lot of examples of this out on the marketplace, but look at AT&T for an example. That company has paid 8 to 10+% dividend for years. That's because Wall Street doesn't want to own it. So the stock goes lower, that dividend goes higher. It has to entice people to buy it. Well, what does an 8 to 10% dividend tell you? It tells you that's probably not the most sound fundamental company. Okay, same is true on a larger scale with the US government's fiscal situation. Okay, fiscal is government and Congress and spending. Monetary is the Fed, just so we're on the same page. It's just telling you the fiscal outlook for America doesn't look as good. It looks like deficits are going to continue to be high, so on and so forth. Well, the other side is inflation and, Fed funds rates. They do have a little bit of an impact on 10-year Treasury yields in a normal market. Hasn't been the case recently. Now, as I reported earlier, 10-year Treasury yields fell about 10 basis points today. And I think 4.5% is a pretty important, kind of psychological level for Treasury yields. Last time you hit 4.5%, you did end up going to about 4.77%. And this was on January 13th, and you hit a high of about 4.80%. You are down 38 basis points since January 13th. Really, that's around the time where DOGE actually, started to become a topic of conversation, right? The inauguration was on the 16th, and, well, after then, 10-year Treasury yields have actually still fallen about 18 basis points. I think Wall Street might be starting to say, with all of this corruption being, uncovered, let's just call it for what it is. USAID is full of corruption. Whether who cares about your opinion or not on this topic, that is a fact, okay? Shutting that down is 1% of our yearly budget. 1% was just saved by shutting down USAID. Let alone what else could be shut down or reformed in the next coming months or so. The fall in 10-year Treasury yields, I think, is much more tied to DOGE than you would think. Okay, now, as the economy potentially softens a little bit, DOGE will have an impact on that. Okay, government spending has massively propped up our economy the last couple of years. That will also help to bring down 10-year Treasury yields. You got to be a little bit careful, though, because you don't want a scenario where the economy starts to look like it's going into a recession, although I think we're quite a bit, away from that right now. And also inflation. I think inflation is going to make a lot of progress here in the next couple of months. Even the Fed is saying that. A lot of it has to do with year-over-year comparisons. We had a big inflation spike in the start of 2024, January, February, March. Inflation, went higher than expected. And on a year-over-year basis with lower numbers, it's going to look really good on a headline kind of basis. We just want to see inflation continue to make progress, especially on shelter, on a month-over-month basis in the next coming months. Now, if DOGE, if I'm right, and if DOGE is changing the longer term perspective of what America's fiscal policy could look like, if we get to a place where, as Scott Bessent said today, the 3-3-3 rule, okay? 3 million barrels of oil per day, additional barrels of oil per day, 3% deficits, 3% budget deficits of GDP. This is a goal by 2028. The only way you're gonna get to this, if you do cut back on the deficit spending. So the deficit is about 7% of GDP today. So you're gonna try to more than half that. It looked unreasonable before DOGE started to make progress here in, you know, cutting down government wasteful spending in the tens of billions of dollars. If we take a look at the debt tracker, and it does take a second to load up sometimes, DOGE has saved about $61.5 billion so far. Okay, drop in the bucket compared to what we're gonna have to see to actually get Scott Bessent's plan to be realized. But it doesn't matter. It's kind of like a stock, okay? It's kind of like a stock that has a really good earnings report with a really good story and narrative, okay? Wall Street kind of gives it the benefit of the doubt, okay? That's why valuations on some stocks can get absolutely insane, okay? And they can stay there for a while because the story's good, they're putting up good numbers, and Wall Street just says, yeah, this could last a while. And, well, we're going to discount that into the future. The same kind of thing could start in treasury yields. Now, at the same time, if we continue to see progress on inflation in the coming months, as the Fed says we will, because remember, in early 2024, the Fed was thinking about cutting rates essentially. Late 2023, we had 7 months of progress with inflation. And then the first 3 months of 2024, we had a spike in inflation again. And, well, the Fed was thankful they didn't start cutting rates already. Well, now we're heading to the 1 year, year-over-year lapse of that. So as we get lower numbers in the next 3 months for inflation, hopefully really low numbers, that year-over-year comparison is going to look really good. Now, we just want to continue to see progress on a month-over-month basis. And what the Fed has said recently is they want to see progress on shelter inflation. And I think we're at the tipping point where we are starting to see that progress. For the first time since Q2 of 2010 last quarter, rents went negative. This is market rents. That is a really good sign of continued housing disinflation. We have now had 2 CPI reports with core CPI or super core CPI coming down and essentially shelter coming down. As long as we continue to see that, I mean, mix that with an outlook of a more responsible federal government deficit picture in the next coming years, and yeah, you could have interest rates come back down to the 3% level, 2.75% level, maybe even 2.5% level if inflation really goes away over the next 6 to 12 months. And I think that would be very positive for equities. And I know it sounds crazy and I like to make bold claims, but imagine 10-year treasury yield 6 months from now at 2.75%. Do you think the stock market's going to be higher or lower in that scenario? Do you think broader markets are going to be higher or lower in that scenario? They're obviously going to be a lot higher as long as we're not in some kind of recession. Now, the next 2 days for markets, we do have some important catalysts as well. We have initial jobless claims coming out tomorrow morning, expecting 213,000, and challenger job cuts expected at about 45,000. You do have a speech from Fed Waller tomorrow at 2:30 p.m. and a speech from Fed Daily at 3:30 p.m. I do want to see what they start to say about the reverse repo market because it's getting pretty low. It's now down to $78 billion as of today. Just in the last 4 days, you've fallen from almost 188 billion down to 78 billion. Like, does the Fed start to recognize that now that we've had 3 days in a row of pretty much, or 4 days in a row of like plummeting reserves at this reverse repo market? Could that cause the Fed to be a little bit more dovish on quantitative tightening? Could they, start dialing some of that back soon? I think that could be interesting to hear from the Fed and to see how the markets react to that, especially the bond market. So we'll see if we get something on that coming tomorrow. And then on Friday, we get the big data with non-farm payrolls, expecting 170,000 job ads. It's closer to like 168,000, but they're rounding, it looks like, to 170. I'm fine with that. Unemployment rate expected to stay at 4.1%. You get government payrolls, manufacturing payrolls, average hourly earnings, participation rate, and much more. And then Fed Bowman speaks at 9:25 in the morning. And then you get the Michigan Consumer Sentiment Survey that will be coming out as well Friday morning. What Wall Street likes to pay a lot of attention to is 5-year inflation expectations and 1-year inflation expectations. I'll tell you though, gas prices have recently come down, and that seems to be one of the bigger things that actually influences this survey. So gas prices coming down should lead to lower expected inflation, and that would be positive for markets as well. We also have some pretty big earnings from Eli Lilly, Roblox, ConocoPhillips, Peloton, Hershey, Bristol Myers, Tapestry, BCE, Yum, Philip Morris in the morning. And then Amazon, multi-trillion-dollar company, obviously important, especially for the cloud. That's what people really care about when it comes to Amazon. You got Elf, Cloudflare, Affirm, Fortinet, Microchip, Pinterest, MPS, and Powell as well tomorrow and after hours. So basically what I'm trying to say here, I know it's complicated when you're thinking about treasury yields and, basic principles. People think that the Fed controls interest rates, and they don't. They control the short end of the curve. They don't control actual interest rates in the economy. So if that is something that Trump is focused on, I expect that DOGE will continue to make a lot of headlines, continue to cut a lot of spending, piss more people off, but it's likely going to benefit the bond market. It's likely going to bring down those 10-year treasury yields. And what will that do for equities? That will be a massive positive. Now, I think it's going to be interesting because big tech has really carried markets higher. A lot of stocks within the markets have not done as well. I do think you will get a broader kind of market rally where more stocks start to do well. And it'll be interesting to see what happens to big tech under that kind of framework as rates do come down. But generally speaking, it will create a little bit more euphoria in our markets. As I've talked about plenty of times before now, percent of stocks trading above their 50-day moving average is only at 51%. So as markets are at all-time highs, half of the markets are not even above their 50-day moving average. Like half the markets are not doing good at all. Okay. And people still feel pretty bearish out there. Look at the CNN Fear and Greed Index sitting at 40. I mean, this is not like a super overly, optimistic market. So I really felt the need to make this video because I think we are in the very early innings of this new administration, clearly, but really the fall of 10-year treasury yields, I think, is only just getting started. Scott Bessent is going to be a massive driver of this alongside DOGE and Trump's initiatives. And again, I think we're already starting to see progress on this. And if you actually take into consideration the possibility that this information could be correct, then I do think you're going to be in a much better place in your portfolios 3 to 6 months from now if you position for it. Now, does this mean go all in on margin right now? Obviously not. But I do think you want to be more allocated to stocks than under allocated. Like, this is not the time to sell everything and wait for a better opportunity to buy on markets. Just in my personal opinion, that's not financial advice. That's not a recommendation. I am not a financial advisor. Before you buy, sell, trade anything, contact a financial advisor if you are unable to make your own financial decisions and feel confident in those decisions. I'm not going to tell you what to do. I'm going to tell you what I'm doing, and that is staying fully exposed to this market. And I do like the broadening trade. I don't like big tech today, right? That remains true. I like AI software. I like data centers. I like mid-cap names. Not a big fan of large cap. It'll be interesting to see how large cap does relative to small and mid cap as 10-year treasury yields continue to come down. And I think that's going to be something we'll just kind of have to wait and see what happens. But that's where you could get some underperformance of perhaps like an Apple, right? Trading at very high valuations with limited growth. 10-year treasury yields come down. There's less of a reason, to own something like an Apple. Okay, so just wanted to give you guys a heads up on this. It seems like we finally got some clarity what Trump meant by lowering rates. Not actually just having the Fed lower rates, but doing the hard work that is required to have Scott Bessett's plan come true. And that plan from Scott Bessent brings with it lower rates. And I think markets are already starting to price that in to the bond market. By the time Wall Street's talking about this, the rally is going to be insane. Just in my personal opinion. I think you want to be positioned before that, but obviously could be wrong. Let me know what you think about this information down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.